Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance with a video update on Friday, July 21st, 2023. When I started out as a stockbroker 40 years ago, the Dow Jones Industrial Average was the gold standard for the stock market. The Dow, as is commonly referred to, was widely quoted by the financial media around the world. Now, here's a listing of the 30 stocks that comprise the Dow, and you can see that United Health Group is the single largest holding, all the way down to the smallest holding, which is Walgreens. But that's not the case anymore. Now the S&P 500 is the index that's used as a proxy for the stock market. In part, that is due to the enormous amount of money invested in index funds that follow the S&P 500. However, the recent performance of the Dow is encouraging since it can be viewed as a harbinger for what's to come. This week, the Dow closed above 35,000 for the first time in nearly 2 years and is within a few percentage points of its all-time high. So here's a chart of the Dow Jones Industrial Average going back 5 years. And if we shorten this to 2 years, you can see here we are today, right around 35,300. And if you look to the left, right over here, peaked out a little over 36,000. So it's getting very close to its all-time high. Now that is significant for two reasons. There's not a lot of index money tracking the Dow. So the primary reason to buy those stocks is because you believe they are going to appreciate. And since the Dow is an industrial index, it would not be expected to be near its all-time high if most Wall Street portfolio managers believe that a recession is imminent. True, there is some overlap between the Dow and the S&P 500. Both indexes hold Apple and Microsoft, which are two of the most valuable publicly traded companies in the world. And you can see here that Microsoft is the third largest holding in the Dow, while Apple is the 12th. But the Dow's biggest component, as you can see here, is United Health Group, which is considerably smaller than the mega cap tech stocks that dominate the S&P 500. The Dow's second largest holding is Goldman Sachs, a global investment banking firm that is heavily reliant on economic activity for its revenue. And then the fourth largest holding is Home Depot, whose fortunes tend to rise and fall with the residential real estate market, which in turn is sometimes treated as a proxy for just the overall health of the economy. Those businesses are quite different from the mega cap tech stocks that dictate the performance of the S&P 500. They are not viewed as being recession-proof. In fact, just the opposite. They are cyclical in nature and reflect expectations for future economic growth. To be clear, I do not believe that the Dow is superior to the S&P 500 as an investment vehicle. Over the past 4 years, the Dow has delivered a total return of 29.6% versus 51.9% for the S&P 500. This year, the Dow is up 6.3% compared to 18.1% for the S&P. That discrepancy in performance is primarily due to the mega cap tech stocks that dominate the cap-weighted S&P 500. Those businesses are inherently more scalable and less reliant on consumer spending for the revenue than the industrial stocks that populate the Dow. That being the case, it is the direction of the Dow that matters more than its relative value to the S&P 500 or anything else. And right now, its direction is decidedly upward, which portends good news for the economy in the weeks and months to come. Thank you. That's this week's PF video update, and I look forward to talking to you next week.